Hello and welcome to News in Depth with TVP World. I'm your host, Maciej Wilowski. It's an uncertain time for the global economy, with long-established rules on everything from global trade to geopolitics being radically reshaped. Joining me today to discuss these trends and their impact on Central Europe is Raffaella Tenconi, chief economist at London-based investment group Wood & Company. Raffaella, pleasure to be with you. Thank you for joining us. So, Raffaella, I'd like to begin our discussion today with a brief mention about the national security strategy that just came out of Washington. Now, in that report, which does not shy from criticizing Europe, there is mention about Central Europe, particularly that the U.S. should pursue closer economic ties with the quote-unquote healthy countries of Central and Eastern Europe. What would the region gain from such closer economic ties, and should the region pursue these ties, even if it comes at the expense of the EU and Western Europe?
Well, good evening, everyone. It's a pleasure to be with you. I think the notion of closer ties, if it is within what is a normal relationship, bilateral relationship with the US, I think there is no downside to it. The problem in the document is when it starts talking about at the expense of the EU relationship. That's where, to be frank, it doesn't exactly have a real clarity of what does that mean. Because the EU, first of all, is stronger when it's together. You know, one of the reasons why at the end of the day the trade deal is not as bad as the first tariff rate that was put forward by the US in April, but for the EU at large is much lower, is because the EU stuck together and there was one negotiating point. Now, you could argue that maybe that deal is not perfect, but each member state on its own would have probably got not necessarily as good of a deal and lasting deal. So also the EU trades largely with itself, actually. So although you could argue maybe you could increase on margin your trade with the US if you have a special relationship, it's not a given that the conditions would really be that much favorable to you, and you may miss out actually on a much bigger market reality for Central Europe. So I think the strategy is not very realistic in what can be genuinely in the best interest of Central Europe.
Okay, thank you so much for that reply. Now, mentioned in the same document, overregulation is something that, according to the authors of the document, have hobbled Europe's economic growth and particularly its innovation potential. Are these concerns valid in your opinion, and is Central Europe being affected by this overregulation as well?
Yes, it's a valid argument that Europe overregulates, or that it became too much focused on regulation rather than a balance between economy and regulation. Though this is something the European Commission is already trying to tackle. I mean, starting from 2025, there's been an effort to try to scale down regulation. And of course, it depends on each member state to put forward what would be the best area to start with. So I think the concern is legitimate, but something is already being done. And what I think is most important for everybody to understand is that has the economic weight of Europe is rebalancing, right? Because the weight of Poland and the weight of Central Europe is now as large as some of the older member states in the Eurozone. Then it's up to those countries to put forward the next leap in terms of economic strategy.
Absolutely. Now, moving over to the topic of global trade, you know that Central Europe is very heavily dependent on trade when it comes to fueling economic growth. And since the latest round of U.S. tariffs that were introduced by the Trump administration with Liberation Day, we see that the economic impact on our region has not been perhaps as big as what a lot of economists were fearing. What could be some of the reasons behind that?
So there are two main reasons. First of all, an indirect benefit of having the US so aggressively realigning its foreign policy and putting pressure on Europe to ramp up its own defense is that the EU defense ramp up has very important spillover for growth. And Central Europe, being the more flexible part of Europe, is already showing the benefits of that. So although maybe on trade friction there is a loss, in the aggregate, actually, the defense ramp-up is already giving benefits to industrial production and industrial expectations. The second issue is what I mentioned before. The EU trades with itself. So German exports, for example, outside of the EU are down 13% year on year. But German exports within the EU are actually meaningfully up. So the net basket is still up. And if German trade is up in the aggregate, it means Central Europe is also shielded from the tariff disruptions.
Now, staying on the topic of trade, and now that you mentioned Germany, which ties into this as well, we see that the auto industry is a very big sector here in Central Europe, particularly in countries like the Czech Republic and Slovakia. Now, in recent years, amid the surge in Chinese exports of automobiles, including to Europe, does this pose a threat for the region's auto industry?
Well, it is undoubtedly that the EU auto industry is under pressure. And you can see also in their ability to pass on costs relative to what they did in the past. So yes, it's also true that some of the auto jobs will need to be destroyed at the EU level, and some of them probably also in Central Europe. Now, to what extent that is a problem? First of all, it depends what is the technological readiness of each member state. Czech Republic actually, for example, is leading in this field. So although it's highly exposed to autos, their export performance has continuously moved up every year because they're gaining market share relative to other brands. Second issue is that there is proximity between the skills needed for auto workers and defense-related production. So what we see is churning. The auto industry is scaling down, defense industry is scaling up. So net-net, the economy actually is not suffering real job losses.
Thank you so much. Now, a topic that has been on, I think, every investor's mind recently has been AI. And there's been a lot of talk about how AI could impact the American economy, the US economy, but at the same time, I think people forget that other regions of the world, particularly here in Central Europe, could also be impacted by perhaps productivity gains related to AI. So what benefits could AI specifically have on our region?
So AI on the US is a bit of an extreme situation because they benefit from both the financial deepening of their market as well as the direct productivity of AI itself. In the case of Central Europe, financial deepening that is related to AI is curtailed because financial markets are not big enough at this stage. And if you have unicorns, they're probably listed somewhere else. But in terms of productivity, certainly robotics does help. And AI deployed in the green transition, it does help. Of course, as the region is short of labor because of the demographic challenges ahead, AI is going to be helpful over time. That being said, AI also causes some costs in that it significantly favors information expansion, and the quality of that information then can actually be of varying quality and sometimes very poor, and it can shape expectations that then have implications for financial markets. So from an economic perspective, when you think about AI, yes, you can consider the productivity gains in the long run, though I stress that it takes a few years before that productivity shows up. But you will have to counterbalance the damage that bigger cybersecurity threats and bigger misinformation will cause in terms of financial markets.
You had mentioned the demographic aspects regarding AI as well, and as we know, Central Europe has very unfavorable demographics when it comes to future projections. How effective can AI be to counteract the declining labor force in countries like Poland and many neighboring countries?
I mean, it's a difficult question that you pose because it depends, first of all, on the cost of energy, right? How much AI you're really going to be able to deploy, in what functions, and to what levels of sophistication. We will see as the price of energy unfolds. It certainly can help, although I think when you look at growth projections in the region, you don't really need that much more AI deployment to have very favorable growth outlook, very significant increases in per capita incomes. Mm-hmm. So I would suggest that while AI is definitely an important topic, you may gain more as an economy by just doing what we already know, which is either adoption of knowledge that we already have, or simple, effective policymaking.
So looking at individual countries in Central Europe, we see that Poland, at least this year, has been a consistent economic outperformer with a GDP growth near 4% year over year. Meanwhile, economies like Slovakia, Hungary, and Romania have been largely stagnant over the past year to 18 months. What factors do you think account for this economic resilience on the part of Poland?
First of all, I would say Poland is a large recipient of EU funds in broad terms, and the government has been effective in accepting the funds and deploying that. If you look at Hungary, actually Hungary is not benefiting from all of the earmark funds because it has a rule of law dispute with Brussels. So this is the first thing. Second of all, the corporate sector in Poland is very well run in the aggregate. It has gone through a period of balance sheet restructuring in the last 12 months. But by and large, it is strong enough that it has been able to restock. So its investment in the form of inventories earlier than other countries. And this is partly due to its managerial skills, partly due to its support, partly due to the fact that expectation of the private sector on the Polish economy are very favorable, which is absolutely not the case for Hungary or Slovakia, for example. And the third element, there is no investment cycle without having robust domestic demand. Polish households have benefited from higher savings buffers than in the past and positive real wage. So consumption recovered faster than other countries.
Now, one of the factors that I think determines consumer confidence or the level of confidence the most is inflation. And we see a significant disinflation process in Poland where I think inflation has been cut in half essentially since the beginning of the year, from 5% to about 2.4% as of the November reading. Do you expect this disinflation trend to continue in the coming years?
I don't expect inflation to get much lower than where it is right now. So it could be 2%, but it will hover between 2 and 2.5%, because a lot of the improvement that you received, especially in the last print, which is November, it reflects food inflation. Food inflation globally was slowing down, and it was a matter of pass-through into Poland eventually. Next year, probably, we think cost of energy will come down for households anyway through policy-making decision. But because the labor market is so robust, and the economy is vibrant, you will have probably services inflation reaccelerating. So I think you've brought inflation from meaningfully high into within the target range of the central bank. But to expect disinflation or even deflation, you would need a meaningful external shock to completely change the growth picture.
Okay, thank you so much. So now one of the biggest risks that economists have warned about regarding the Polish economy is the rising budget deficit and also debt levels. Is this something that we should be genuinely concerned about? Could it lead potentially to credit rating downgrade or to a spike in government bond yields for Poland?
No, we don't really think any serious downside risk to the credit rating in Poland in the next 24 months. We also think that at least for 2026, funding will remain smooth. You could even see bond yields coming down. The Ministry of Finance actually is very diligent, always pre-finances for the following year part of its issuance needs. So the market is completely capable of absorbing all of the issuance. I think what your question is really hinting at is whether the size of the budget deficit is worthwhile paying in the long run. So is fiscal policy really prudent, as it should? And my answer is there are certainly elements of that budget which are worthwhile. I mean, Poland is the largest spender on defense relative to other EU member states, so that is a front-loaded cost. Are resources appropriately deployed and managed in areas of education or of healthcare? Maybe that's where you could probably do better, and that's the area where in the long run you could see the productivity leap that you need for AI adoption, right?
And when it comes to the political polarization currently in Poland, including the conflict between the president and the prime minister on a lot of economic aspects, is it reasonable to expect that there won't be any fiscal consolidation ahead of the elections that are coming up in 2027?
Yeah, I think it's absolutely reasonable to expect that. And we think that probably in 2027, there'll probably be fiscal easing anyway.
Okay, thank you so much. So moving on to Hungary, because we have a little bit more time, we see that there's going to be a very, you could say, publicized election coming up in Hungary in 2026. And according to the current polls, Prime Minister Viktor Orban's ruling party Fidesz is polling roughly neck and neck with Peter Magyar's TISA. What ramifications for the Hungarian economy do you feel this might have, and which party would be better position to enable economic growth in Hungary?
Well, first of all, the Hungarian economy is highly export-oriented. And at the moment, it's not displaying as much signs of industrial recovery as other parts of Central Europe. But by just its sheer structure, eventually it's going to have to reaccelerate just like every other country. So the economy, to some extent, may not be really growing that fast in 2026, but by 2027, if Europe has a recovery in place, it will definitely reaccelerate faster than what most people think, regardless of who is the prime minister. Now, between the two candidates, there is a fundamental difference. The new party, TISA party, is very keen to reactivate all of the EU funds flows, and it's open to adjust whatever is needed on the legal side to allow Brussels to disperse. So it's definitely going to have a positive impact on the potential growth of the economy as things stand, because currently the investment rate in Hungary is extremely low and way lower than what Orban delivered in the good years. On the other side, Orban could actually and will actually deliver a certain stability of economic policy, certain stability to economic players in Hungary. So I think under him you will see the currency appreciating significantly relative to current values. So it depends which option do you prefer the most.
I'd also like to briefly touch upon the Romanian economy, because Romania has recently been in a crisis, a fiscal crisis, where the government has introduced unpopular austerity measures. Romania currently has the largest budget deficit in the European Union as a share of GDP. And in your report that Wood & Company highlights, Turkey and Romania could face some of the biggest challenges when it comes to restarting economic growth and ramping up growth because of those concerns. So could you elaborate a little bit more on the Romanian economic situation?
Yeah, the thing about Romania is for the last almost 10 years, fiscal policy was extremely lax for a variety of reasons. But coupled with the fact that the economy was growing very healthily and the labor market tightened, it made consumption way more than what fundamentals would require. So the savings rate in Romania until last year was actually negative among households, whereas it's 10% in Poland, just to give you a sense of magnitudes. And it only turned slightly positive in the first quarter of 2025. So Romanian households, to start with, they need to rebuild their savings buffers. And because of the fiscal measures which have increased inflation as of August of this year, real wages are meaningfully negative in Romania and will remain negative for another year. So this is what is a drag on GDP performance, certainly over the course of 2026, and is going to cause a certain amount of malaise among Romanian households.
Thank you so much for that. Well, Raffaella, since we're running out of time, I think we'll wrap it up here. I'd like to thank you so much for joining us today. Raffaella Tenconi of Wood & Company, thank you so much, and I hope you have a great day.
Thanks a lot.
That's all for tonight's edition of News in Depth. I'm Maciej Wilowski. Stay tuned for more on TVP World.